Hey everybody, Dr. Phil here. So this is going to be a video on just some things that I want you to know about the capital markets, a little bit about the history. So the first thing we're going to talk about is dollar returns. So if you buy an asset of any sort, your gain or loss from that investment is called, you probably heard the term ROI, right? Return on investment. There's really two components of ROI. Okay, so you may receive some cash directly while you're in the investment. So that's called the income component. So that could be like dividends on stock, interest on payments, coupon payments on bonds. Number two, the value of the asset you purchase will often change. Of course, you want it to go up, right? In which case, you could have a capital gain or a capital loss on your investment. So suppose the video concept company has several thousand shares of stock outstanding. You purchase some of those shares of stock in the company at the beginning of the year. Now you're at the end of the year, you're trying to figure out how you've done on your investment. So at the beginning of the year, the stock was selling for $37 per share. If you had bought 100 shares, you'd have a total outlay of 3,700. Suppose that over the year, the stock paid a dividend of $1.85 per share. So by the end of the year, you would have received income of, and then of course, $1.85 per share times the 100 shares, you would have gotten $185 dividends. So the value of the stock has risen to $40.33 per share by the end of the year. So your 100 shares are now worth 4,033. So you have a capital gain of, so plug in the 4033, subtract the 37 you paid, times the 100 because you got 100 shares, and you get a gain of $333. The total dollar return on your investment is the sum of the dividend and the capital gain. So the total dollar return equals the dividend income plus the capital gain or the loss. So in our example, well, you just add the two together, right? The 185, the total dollar return, 185 from dividends plus the 333 capital gain. So the return is 518 bucks. If you sold the stock at the end of the year, the total amount of cash you would have would equal your initial investment plus the total return. So like in our example, it'd be 3,700 plus the 518, and would give us the 4218. So, speaking of percentage returns, let P sub T be the price of the stock at the beginning of the year, and let D sub T plus 1 be the dividend paid on the stock during the year. So in our example, the beginning of the year price was $37 a share, and they were paying a $1.85 dividend per share during the year. Expressing the dividend as a percentage of the beginning stock price results in the dividend yield. So the dividend yield equals D sub T plus 1 over P sub T. So just $1.85 over 37 equals 0.05. So the dividend yield is basically 5% of the stock price. The capital gains yield is calculated as the change in the price during the year, the capital gain, divided by the beginning price. So the capital gains yield, again, same formula. So 40.33, subtract the 37, what you initially paid for it, divided by the 37 again. So we just really get the change there in the numerator. Equals 333 over 37, and it comes out to 9%. So another way we could say this, for every dollar invested, we get 5 cents in dividends and 9 cents in capital gains, for a total return of 14 cents on a dollar, which of course is 14%. So let's say you buy some stock at the beginning of the year for 25 bucks a share. At the end of the year, the price is $35 a share, so it's gone up by 10 bucks. During the year, you receive a $2 dividend per share. This is the situation illustrated in figure 12.3. What is the dividend yield? What is the capital gains yield? And what is the percent return? If your total investment was 1,000, how much do you have at the end of the year? So your $2 dividend per share works out to a dividend yield of, and then we just plug in our numbers, 2 over the 25. So the 2, of course, is the dividend per share, 25 is the price, and we get 8%. The per share capital gain is $10. So the capital gains yield, again, just plug in your numbers, it's 35 minus 25 over the 25. So simplify that out, 10 over 25, and we get a capital gains yield of 40%. So the total percentage return is 48%. So if you'd invested 1,000, you would have 1,480 at the end of the year, representing a 40% increase. A pretty nice increase there. To check this, note that your 1,000 would have bought you 1,000 over $25 equals 40 shares. Your 40 shares would then have paid you a total of 40 times 2, $80 in cash dividends. Your $10 per share gain would give you a total capital gain of 10 times 40, which is of course 400. If you add those together, and then there you get the $480 increase. So a little bit about the historical record of the market, the securities markets. So these two guys conducted a famous set of studies dealing with rates of return in US financial markets. They presented year-to-year historical rates of return on five important types of financial investments. So they were large company stocks, small company stocks, long-term corporate bonds, long-term US government bonds, and then US Treasury bills. So basically we have equity and debt representation there. So the first look shows what happened to $1 invested in each of the five different portfolios at the end of 1925. So you can kind of see you've got the Treasury bills. You'd expect that to be kind of low because it's low risk, low return. The government bonds, and then the higher up you go, you're now moving up into the equities market. So small company stocks are actually the highest performing, and then followed by large. So basically, the equities did better. The debt didn't do as well, but of course, the debt is safer. So average returns may be calculated by adding up the yearly returns and just dividing it by the total number of years. So looking at what we just discussed, you can see here the large company stocks, the average return was 12.1. Small company stocks, 16.3. So that was actually the highest performing. Usually because small companies are more lean and more nimble. A lot of large companies are just kind of laden down with bureaucracy, and they're not as agile. And then you can see for the debt down here, they were, of course, the return is less, but the risk is also less. Now, debt represented by Treasury bills or T-bills is virtually free of any default risk. So the return is called the risk-free return, and we typically use that risk-free return, the RFR, as a benchmark. So the risk premium is the excess return required from an investment in a risky asset over that required from a risky investment. And so an interesting comparison involves returns on T-bills and common stocks, with difference between the returns interpreted as a measure of the excess return on the average risky asset. So using the table of average returns from the previous slide, we can calculate the risk premiums for the different investments. So we can see we've got the average returns from the previous slide. Now I've calculated the risk premiums over here. So the average risk premium earned by a typical large company stock is around, if you average it out, it's about 12.1. 12.1 minus the 3.4, we get about 8.7%. Okay, so our first lesson here is risky assets on average will earn a risk premium, but they think about it, they should, right? If you're going to take extra risk, you should receive extra reward. Okay, so the second lesson we want to talk about today speaks about the variability of returns. So a frequency distribution for the common stock returns counts the number of times the annual return falls within each 10% range. Measures of the volatility of the returns are as follows. We can use the variance, which is the average square difference between the actual return and the average return. And then we also have the standard deviation, which is the positive square root of the variance. So here you can kind of see the kind of what looks a little bit like a normal distribution, and that of course is intentional because we would expect it to follow like a normal pattern. Now the variance essentially measures the average square difference between the actual returns and the average return. So the larger the variance or standard deviation, the more spread out the returns will be. So we're looking at historical returns. So the procedure we use is designed to calculate historical variance and standard deviation. If examining projected future returns, then of course the procedure would be different. So suppose an investment had returns of 10, 12, 3, and negative 9% over the last 4 years. The average return would be, of course, 0.1 plus 0.12 plus 0.03 and then minus 0.09. Divided that by 4 to get the average, and we get an average return of 4%. So the first return deviates from average by 0.1 minus the 0.04, so about 6%. The second return deviates from the average by about 8%, and so on and so forth. So to compute the variance, we just square each of these deviations, we add them, and then we just divide the result by the number of returns less 1. So in this case, we have 4 returns, so obviously we would divide by 3. So table below summarizes the information from the previous slide. So you can see the actual returns here in column 1. The average return, of course, is the same for all of them in column 2. We've got the deviations, which of course is just subtracting 2 from 1. And then we have the squared deviation. So the variance can now be calculated by dividing the 0.0270, the sum of the squared deviations, by the number of returns less 1. So if we let V parentheses R, or the standard deviation squared, stand for the variance of the return, then we plug in our numbers, we get the 0.027, and then over 4 minus 1, and we get this 0.009. The standard deviation is the square root of the variance, So if we plug in those numbers, we get the standard deviation of about 9.487%. So think of the variance in the standard deviation as it's kind of another measure of risk, because it's telling you like how much fluctuation those things are likely to do. Doesn't mean it will, but that's the prediction. Now, in general, if we have t historical returns, where t is some number, like time, we can write the historical variance as, and then you can see the formula here. So the formula tells us to do the following. Take each of the t individual returns, so R1, R2, etc., and then just subtract the average return. So this is what this, you can see this R here with like a little line on top of it. That's the average return. Then we'll square the results and add them, and then we'll divide the total by the number of returns less 1, so t minus 1. Now remember, the standard deviation is always, you can take this to the bank, no pun intended, it's always the square root of the variance. So let's take a look. So suppose the Supertech company and the Hyperdrive company have experienced the following returns in the last 4 years. So we've got the Supertech returns, and then of course in the middle column we've got the Hyperdrive returns and the right-hand column. So the question is, what are the average returns? What are the variances? What about the standard deviations? Which investment was more volatile? So to calculate the average returns, we add the returns and divide by 4. So the results are for Supertech, it's about 0.175. And for Hyperdrive, the return is about 0.055. So obviously Supertech is much better performing in that sense. Now to calculate the variance for Supertech, we can summarize the relevant calculations as follows. So you can see where I went ahead and did I did the deviations over here. Again, just 1 minus 2. And then we have the squared deviation in column 4. So because there are 4 years of returns, we calculate the variance by just dividing the 0.2675, look at the bottom line here of the standard deviation column, by 4 minus 1, so of course that's 3, and then we get our numbers plugged in here. So for Supertech, the variance 0.0892 compared to Hyperdrive 0.0176, and then the standard deviation for Supertech 0.2986, and then 0.1328. So a couple of things about this just real quick. So you can see the variance and the standard deviation. The variance for Supertech 0.08 versus 0.01. So of course the variance for Supertech is higher. The standard deviation is also higher. So you could kind of think of Supertech as more volatile. So here you can kind of see an example of the average return and the standard deviation, and then they're plotting it out with a frequency distribution. Just for those 1, 2, 3, 4, 5, 6 types of investments that we talked about. All right, next thing is a normal distribution. So the normal distribution, I'm sure you've done these if you've taken like a statistics class, like an intro to stats. You remember the bell curve, right? So the normal distribution is a symmetrical bell-shaped frequency distribution that is completely defined by its mean and standard deviation. The probability we will end up within one standard deviation of the average is 68%. Look over here in the green. Within 2 standard deviations is 95%. Look at the now including the blue. And then more than 3 standard deviations is less than 1%. So recall from a previous slide that the standard deviation of returns on large company stocks was 19.8 and the average return was 12.1. So the probability the return in a given year is in the range of negative 7.7 to 31.9. So like 12.1% plus or minus the 1 standard deviation is going to be about 68%. But again, that's assuming that it follows the normal distribution. Now, on average, bearing risk is handsomely rewarded, but within a given year, there is a significant chance of a dramatic change in value. Maybe a better way to say that would be, yes, bearing risk is handsomely rewarded, but typically not in the short term. So the second lesson is simple. The greater the potential reward, the greater the risk. So just over a decade ago, 2008 entered the record books as one of the worst years for stock market investors in US history. So how bad was it? Well, the S&P 500 plunged 37%. Over the period 1926 to 2019, only the year 1931 had a lower return. Think about right after the Great Depression, had a lower return than 2008. From November 07, when the decline began, through March 2009, when it ended, the S&P, think about this, lost 50% of its value. So were there any bright spots in 2008 for US investors? And the answer is yeah, stocks tanked, bonds soared. So think about, this, if people don't want to invest in stocks, they'll probably move into bonds and vice versa. Oops, excuse me. All right, let's get back to where we were, which was here. So the historical stock market risk premium has been substantial. Some argue it's been too big and it overestimates what is likely to occur in the future. So we've used the period 1926 to 2019 in this chapter. So did investors get lucky over this period and earn particularly high returns? Was the US stock market experience unusually good? Did investors in other countries not do as well? And then evidence suggests that US stock market risk premium estimated over this period perhaps is a little high. And you can see the US is here at 7.4. The average is about 7.1. You got the UK here about 6.1. And then Italy on the high end at about 10.5%. Okay, next thing to talk about is what we call capital market efficiency. So in an efficient capital market, security prices reflect available information, really reflect all available information. So let's suppose the F-Stop Camera Corporation, FCC, has, through years of secret research and development, developed a camera with an auto-focusing system whose speed will double that of the current systems available. Capital budgeting analysis suggests launching the new camera will be highly profitable. That is, the NPV appears to be positive and substantial. The key assumption is that FCC has not released any information about the new system. The fact of its existence is quote-unquote inside information only. Consider a share of stock in FCC. In an efficient market, its price reflects what is known about FCC's current operations and profitability, and it reflects the market opinion about FCC's potential for future growth and profits. The value of the new focusing system, is not reflected simply because the market does not know about it because it's considered like inside information. So day zero represents the announcement day. Before the announcement, the stock was selling for $140 a share. So the net present value per share of the new system is say 40 bucks. So new price will be 180 once the value of the new project is fully reflected. So the solid line you see over here represents the path taken by the stock price in an efficient market. The broken line depicts a sort of a delayed reaction, if you will. You can see that here. The dotted line illustrates an overreaction and then a subsequent adjustment to correct price. So efficient market reaction, the price instantly adjusts. So see how it instantly goes up here from 140 to 180 and then just keeps on at 180. The delayed reaction, this is the line here at the bottom, kind of the yellow dotted line here. The price partially adjusts to the new information. 8 days elapse before the price completely reflects it. So that's why it's delayed. And then for the overreaction, the price adjusts to the new info, it way overshoots the price, and then, of course, like any market, subsequently corrects itself. So the EMH, the efficient markets hypothesis, EMH asserts that actual capital markets, such as the NYSE, New York Stock Exchange, are efficient. If a market's efficient, then there is a very important implication for market participants. All investments in that market are zero net present value investments. Competition results in the market becoming increasingly efficient. So there are some misconceptions about the EMH. Sometimes it's wrongly argued that market efficiency means that it doesn't matter how you invest your money because the efficiency of the market will protect you from making a mistake, and that's just not true at all. It's not the case. It's sometimes argued that the market cannot be efficient because stock prices fluctuate from day to day. Now, we know that price movements are in no way inconsistent with efficiency, right? The fact that prices fluctuate is, at least in part, a reflection of information flow. So depending on the degree of efficiency, we're going to say that markets are really one of the following. So then if it's a weak form efficient, that says all information of every kind is reflected in stock prices and there is no such thing as inside information. Now, we would say that's probably not the case, right? Because we have seen people get busted for the SEC rule 10B, I believe it is, 10B2 maybe, that deals with inside information. People have been full foul of that all the time. The semi-strong form efficient says that all public info is reflected in the stock price. This is perhaps more controversial because it implies a security analyst who tries to identify mispriced stocks is just wasting time because that info is already reflected in the current price. So there's a lot of debate back and forth on that one. And then the strong form efficient suggests that at a minimum, the current price of a stock reflects the stock's own past prices. But we know that studying past prices to identify mispriced securities has generally been futile. So what does capital market history say about market efficiency? Well, the first thing it says is prices appear to respond rapidly to new information, and the response is at least not grossly different from what we would expect in an efficient market. So that's good. But number two, the future of market prices, particularly in the short run, is difficult to predict based on publicly available information. Again, makes sense. Number three, if mispriced stocks exist, then there is no obvious means of identifying them. So just a little bit there about the efficient markets hypothesis. Okay, that's the end of the video. As always, thanks for watching.